Okay, everybody, welcome to the 4-Star Podcast here. This is the 5th of April, and we're talking about the economy for the end of the first quarter. And we're going to talk about all the crazy things that have been going on in the last couple of weeks here in the 4-Star Today's Market Explained podcast. I'm Brian Kasal, your host, along with my co-host, Mr. Chris Reardon. Chris, are you there?
I'm here, Brian. Good afternoon. Good afternoon to everyone out there, and glad to be on.
Excellent. Well, good. Well, everyone knows Chris is our Director of Development at 4-Star Wealth, and he runs everything having to do with portfolios and marketing and development of new clients and whatnot. So he's extremely valuable guy to our firm, and he's got a lot of great insights on all the things going on in the industry. So welcome, Chris, to the podcast.
Thanks again.
And I'm Brian Kasal, again, your host. I'm the CEO, founder of 4-Star, Eagle Scout, trustee of the National Boy Scout Foundation. I'm a philanthropic advisor and advisor to CEOs and insiders, chief dad to Evan and Quinn, and husband to the amazing Tripty. And just a reminder, if everybody here likes what they're hearing, give us a 5 out of 5 ranking. The more rankings we get, the more people that hear it, and the more we can do, the more information we can get out there. So we're going to do a standard review today. We're going to start out with market discussions about the economy and then also what we see in general out there. And Chris, you always have the numbers on the markets since we last did our last podcast, which was on the 24th of March. So what has changed since the 24th of March, Chris, in the market?
Yep. So some changes here. Nothing, I would say, kind of massive. I would characterize nothing on that point. But commodities still holds the number one position. It did move down 2 points, so slight deterioration there. It's at 324 tally points. Domestic equities in the number 2 position. It moved down 2 points as well to 271. In the third position, the largest winner, if you will, of the time frame was international equities. It gained 15 points to 191 on the third position. Fixed income lost 9 points to 128 in the fourth position. Cash gained 1 point in fifth position to 110, and then currencies still in last place. It lost 3 points to 67. So really the biggest winner in there was international equities. The biggest loser would be kind of fixed income. Everything else was really kind of just a couple points here or there.
So the only real change in strength was in international South Africa, South America, Chris, if I believe that's right. And
yeah.
Those are all high commodity markets anyway, aren't they?
Yep. Yeah. So I mean, South Africa, you have a lot of gold mining, a lot of kind of miners, raw resources there, and then South America is characterized with a lot of potash. You have a lot of agricultural exports there. So it's really been a lot of these smaller countries that have kind of stayed out of the limelight, if you will, from sanctions and the war, but still been able to provide these raw resources that are in high demand and in short supply right now with the war going on in Ukraine. So those have been kind of the biggest drivers, if you will. And then the other thing I'll mention is with commodities, even though it lost 2 points, mostly what we saw there is kind of a large move coinciding with the Ukrainian war. And it hasn't really deteriorated that much. It's just kind of settled down off of those highs. So if you can imagine a 50% move and then kind of settling more into a 30 to 35% move range, which is pretty typical of commodities.
Yes. The commodities are very wild trading, up and down, very volatile. So that's been quite an interesting adventure as we have, and the first quarter here. And Chris, I might mention to our listeners, the first quarter of this year was the worst quarter since first quarter of 2020. So it's the worst quarter in 2 years. The tech stocks got crushed. And at one point during the quarter, the S&P and the broader markets were down more than 10%, which is considered to be in a correction phase. And then the technology indexes were down more than 20%, which is considered to be bear market stage. That's all turned around, however. January and then really February was very rough. But then March was an up month. So the S&P was down just a little more than 4%, with the broader indexes the more narrow indexes a little bit more. So, but now we enter the second quarter with the worst quarter in 2 years under our belt, where the S&P 500 is 99% overbought, according to our friends at Canterbury, one of the research houses that we work with, our friends Tom Harden and Brandon Bischoff. So 99% overbought. So those are what's one of those Wall Street terms, like overbought. How can something be overbought? Well, what that means is that relates to a trading range. So if the markets are generally rising and they trade back and forth in a range, then if it's at the high end of that range, it's considered to be overbought. So the mid range, it's like equal, not overbought, oversold. So we're way at the high end of the normal range on a short-term basis. So this little rally we've had in March has been really powerful because the markets were down a lot more at the end of February. So maybe this trend will continue. So we're always trying to figure out, is this the beginning or is this just a little rally within a big, longer bear market, or the bottom's already in for the near term in February? And time will tell, right, Chris? We don't even know. We just have to follow the evidence. And we haven't seen any real confirming signals that this is a broad-based overall rally. But right now the markets are a little bit extended on a short-term basis. So now we might see a little bit of weakness. And then if it's going to go back upward, then that would be the confirming signal. So that sounds about right to me, Chris. What do you think?
Yeah. I mean, I think there's a lot of variables out there too. Just in the environment we're in now, it's very event-driven. We have that war going on, Ukraine. So any major updates or changes to that could have significant impacts on the market. And then the Federal Reserve, which is in the process of raising rates, any deviations or changes from that or accelerations could have major impacts. So we're in a very sensitive time period. And I think trying to predict any of that is, it's impossible.
Right. Well, now just looking at the U.S. economy, we saw U.S. retail sales started to slow. A bunch of different numbers, Chris. You've got a whole list of them.
Yep. So retail sales, they rose, but they did slow kind of over the previous month. They rose to a seasonally adjusted 0.3% in February over January. And this, what they kind of saw is consumers spent more on gasoline and vehicles. What they cut back on is online and discretionary spending. So we're already seeing these high gas prices kind of start to pinch the wallets of consumers. And they're having to choose where they need to spend that money. Remember, money is a limited resource for most people. So, if you can't spend it, or if you have to spend it somewhere else, you can't spend it, buying a new fun gadget on Amazon. The initial jobless claims came out. They fell by 15,000 to a seasonally adjusted 214,000. That was for the week ending, I think, for April 2nd. And then the employers, they added 431,000 jobs in March. With the unemployment rate falling to 3.6%. So we continue to see a very robust and strong job markets, which is very positive. The number of job openings was little change, is at 11.3 million, and that was at the very end of February. So once again, still a lot of job openings, still very strong labor market is what we're seeing.
Yes.
And then on the kind of the home sale or real estate front, existing home sales fell 7.2% in February from January to a seasonally adjusted 6.02 million. And that difference was 2.4% year over year. Sales fell. So February from February, they fell 2.4%. Most of this drop, we have higher interest rates now. Interest rates are rising, so we have higher interest rates. But most of the drop, surprisingly, was actually attributed to supply. We have an increasing shortage of supply, and potential sellers are reluctant to go on just to list their house because they don't want to be exposed to the current real estate market and having to bid for a house, maybe be exposed to a higher interest rate than they're currently locked in for. On that note, I'll say the average rate for a 30-year fixed mortgage, it jumped to 4.67%, which is the highest reading since December of 2018. It's almost 4 years. That number jumped from 4.42% week over week. and then jumped from 3.22% to start the year. So almost a 1.5% jump on mortgage rates from the beginning of the year to really, we could call it the end of March. That's a very substantial jump, and then that's obviously having an impact. But surprisingly, like I mentioned, we're not seeing that slowdown from home buying activity as we would expect. The number of applications submitted for mortgages from hopeful home buyers rose 3 out of the last 4 weeks. So we continue to see it almost accelerating the home buying. So we continue to see a strong real estate market. And then the last thing I'll mention, I thought this was kind of cool. Female wage growth is increasing at a faster rate than for men. Female wages are up 4.4% in February year over year, and that's compared to a 4.1% rise in male wages. And then in December, female wage gains exceeded male gains by 0.5%, 50 basis points, and that matches the widest margin ever, tracing back to 1997 when it was recorded. So, it's good news as well.
Raise a glass to the ladies. Congratulations.
So that's a good trend and something hopefully we continue to see.
Excellent. Well, good. Well, those are a lot of great numbers, Chris. And, so we're getting like conflicting inputs, good inputs and bad inputs. We're seeing inflation. We're seeing some crowding out of spending. So eventually that can affect the economy as well. And then we talked about how the bond market, the yield curve is inverted, meaning that you'll get a higher yield for shorter term money than you will for 20 or 30-year money. And so that is highly correlated with the recession. So now, of course, some are insisting there will be a recession, but it's not 100% correlated. So it's only about 80%. So there's still a possibility we don't fall into a recession. So why would this time be different? Well, there are a lot of weird things that have gone on in our economy because of the pandemic and a lot of crazy things that we've never thought we'd seen before or would see ever again, like this big inflation. And then also, while we were having an economic slowdown in January a wee bit, and then inflation was starting to hurt the economy, then this war started with Putin and Russia going off into Ukraine. And of course, they got blamed for the oil price, but that was already up much before the war, and they got blamed for inflation. That went up much before the war as well. So, there's a lot of things that are going on that are confusing to a lot of people. So we just have to keep watching the evidence and see what the markets do. The Fed is going to raise rates again, expected to raise 50 basis points. And the betting is now that at the next opportunity, they're going to do that. They just did 25 basis points last month, and it appears they're going to do more. Jamie Dimon thinks the Fed will go very fast and raise rates pretty sharply. Bill Gross, the bond king, warns that the Fed rate increases will crack the U.S. economy, and maybe that'll lead to that recession that the market's signaling or the bond market is signaling. So it's a really funky time. The sectors that are doing the best are energy, and now once again technology, and then healthcare. Although healthcare on our work is the stocks are still ranked negatively, but energy and technology are very strong. So that's kind of what we see in the economy. Another really interesting thing that has been developing is with inflation kicking in the last couple, maybe 6 months or so, Chris, we've seen the evidence of shrinkflation. We can thank a couple of our good friends for that comment. Shrinkflation is where you still pay the same amount for a certain good, but you get less of it. Or you get a cereal box that is a little smaller for the same price. So they're shrinking the units and charging the same amount. So shrinkflation is happening. It's just another form of inflation, a unit price inflation, essentially. And so that's really been a big issue. So, the jury is still out on this economy. We really don't know where it's going to go. Chris, Bob Barone, the 4-star economist, believes that there will be a recession and believes that the Fed is causing most of the problems with their quantitative easing. Now they have quantitative tightening, and now they're going to raise rates right at all the wrong time, according to 4-star economist Bob Barone. So we'll see. We're going to have Bob and Josh on with us again in a couple of weeks and see what comments they want to offer. Bob writes in Forbes magazine, so you can see some of his work there, either online or in the magazine itself. But we'll have a personal visit with Bob on the 4-Star podcast. So anyway, that's what we see so far. Chris, the other thing, we talked a little bit about this war. It looks like Russia could be losing the war, or they could be just changing tactics to try and get a little bit of territory and then end the war.
Yeah. I mean, I think Russia's initial advance was, I think, in their thoughts, they were going to win the war in their mind in a week. They were not going to experience the resistance they experienced. They were going to be able to kind of decapitate the government there, install a puppet government, which was, in there before 2014 when they was overthrown. And, I think what people don't realize is to actually hold a country the size of Ukraine, which the landmass of Ukraine is the second largest landmass on the continental Europe, outside of Russia. It's a very, very, very large country. So I think right now we're seeing Russia come to the realization that with the current atmosphere, with the current environment they're not going to be able to do that. So they're kind of withdrawing, I think, putting a more concerted effort into the east and southeast, and just trying to take where they can take and hold, especially with troops amount, because they don't want to put 500 or 1 million troops into Ukraine to hold the entire country. It's going to cause more issues.
Yes. Well, and recently, the Ukrainians have been winning. Everyone's concerned about what would happen to the economy. And it seems like, a couple of things are happening that will be a legacy of this war. One, for sure, is that 20% of the world's grain markets are in the countries of Russia and Ukraine. Russia is being hampered significantly by all the sanctions, and the sanctions will get worse. The Ukraine obviously is not open for business. They're defending a war. So there's not much production going on there. And so that's going to affect grain prices. It's going to affect food prices as well. So that's certainly an issue. But unless something really crazy happens, like nuclear bombs and things like that, the rest of the war's issues probably shouldn't affect the world economy as much. The fear factor is certainly there. And that's what we're concerned about, but it seems to be less and less important. So hopefully that continues to be the case, and some sort of negotiated settlement ends this conflict, and then we don't have to worry so much about that in the world. Very sad for all the people in Ukraine, all the atrocities and things that we've been hearing about recent days. That's all very, very sad. And from the perspective of the economy, hopefully it isn't going to be as much of an issue. When the war started, the administration started trying to blame the war and Putin on gas prices and inflation. And in fact, the recent speech, the president said, number one was that the gas prices went down as gas consumption totally died. And then, of course, the war started and gas prices went back up, and he blames all of that on Putin. So what do the people think? Well, recent poll, 68% of Americans blame Joe Biden personally for inflation, for his policies. 68% blame Joe Biden for gas prices, and 66% disapprove of his job performance. So, while the administration is blaming Putin and the war, the public doesn't seem to be buying it. Chris, you had looked into changes, though, from this war regarding currency and settling in dollars or in other currencies in oil, right?
Yeah. It was kind of mid to late March that news broke that Saudi Arabia was in talks to trade oil with China utilizing the yuan instead of the dollar, which doesn't seem like a big deal, but it's a very big deal. Since really the 1970s, the oil market's been pretty much completely exchanged in dollars. It's been termed the petrodollar globally. And, it provides a big boon for the dollar, especially as the reserve currency. And, so if Saudi Arabia does go forward with this, which isn't too big of a stretch. In 1970, the United States was the biggest consumer of oil. Now China is the biggest consumer of oil. So I would say it's not out of the realm of possibility if they went forward with exchanging oil or selling oil to them in yuan instead of dollars. It would start to kind of put cracks into the foundation of the current environment we're in. So, we'll see what happens there, but it could set a big precedent. We'll see if they go forward with it.
Yes. Well, and then we've seen gold. We talked on the last podcast. Gold is breaking out to all-time highs, and gold hadn't done anything for a long time because Bitcoin and the cryptocurrencies were taking most of the action in the anti-currency world. But now gold is starting to run as well, and that may be a reflection of this concern also, that maybe the dollar isn't the reserve currency, or will at least get crowded out in the desire to settle in Chinese yuan or in Russian rubles. But at the same time, those economies aren't as reliable as the U.S. economy. So I'm not sure how many people are going to want to be trading currencies that are so volatile because of political instability, where there's less political instability in the United States. But on the margin, it could affect things to some extent, and that's why gold's running. If you look at the gold prices are running, and then the gold mining stocks are running, the major miners, the big ones, and then the small ones that trade like up in the Toronto Exchange. There's ETFs that trade these things. And so if you look at those ETFs, they're breaking out on the upside. So as we said in the last podcast, that Bitcoin is the new gold, and we were saying that for a couple of years. And now we're saying gold is the new Bitcoin, or maybe gold is the new gold. And so it's starting to run up here. So, that might explain it. Many times things happen in the markets that aren't really always explainable. You'd have to probably survey everybody that bought gold and find out what they're thinking. But many of the people are saying the things that we're saying right now. So, Chris, Elon Musk did something interesting recently, didn't he?
Yep. So Elon Musk, it was disclosed, I believe it was just this morning, that he took a 9.1% stake in the company Twitter, which he utilizes to kind of voice his opinion. And, he's been, if you will, subject to certain terms of the platform. So he decided to take a 9.1% position. And then recently they just asked him to join the board for Twitter as well, since he has the largest stake. So, if it's, what do you do if you're one of the richest men in the world and you feel like your voice is being silenced? Well, you buy out the company.
Well, it's a win for freedom. It's a win for free speech. And I saw today on the news that he was out there soliciting ideas for how people think that he should open up the freedom on the Twitter site. Now that he's the largest shareholder and he's a board member, he has a lot to say about it. So it'd be interesting to see the evolution of Twitter now. And also, I just wanted to mention in the last podcast, we talked about the world coming back, and we had just had the St. Patrick's Day parades in Chicago, and things are starting to happen. Even last weekend, we saw, on Michigan Avenue in Chicago, the Magnificent Mile, where there were always tons of people out and shoppers. Well, that hadn't been there for quite a while, but it was again last weekend. So the last month or so has been very good. So all the things that we remember about American society prior to the pandemic are starting to come back. In fact, recently the New York mayor kept masks on children in schools, and boy, a lot of backlash on that. So the public may have been okay with some of the restrictions in the beginning of the pandemic because they were nervous, but now people aren't about that anymore. They really want the country to open up and go back to normal. And if there's pockets of problems, deal with them, but not interrupt the entire society and put people out of work and things like that. So, but it's great to see, Chris, the world's coming back to life. And that's great. It's going to be a great summer in America. And let's hope that we don't fall into a deep recession, if we fall into one at all. We will always, for our clients at 4-Star, execute on the 4-Star protection program. We've done some of that already here to protect value when the markets were crashing, and it worked very, very well. Recently, commodities have been really the reason why some of the portfolios have been doing well. But commodity stocks have been up 20, 25%, 30% in just a couple of weeks here. And I think everybody should be careful that anything that can move that quickly in such a short period of time, that far, can also move down that quickly. So, and sometimes they move down quicker than they move up. So be careful if you're trading commodities. They can be very, very volatile. We have some in our portfolios, dynamic portfolios, and ended up having a very good first quarter relative to markets. But nonetheless, you got to be careful trading that stuff because it's pretty crazy at times. So with oil prices and everything moving. So that's where we stand right about now. We're going to be back with a couple more really interesting interviews over the next few weeks with different players in the economic system. We just recently had a podcast released with two real estate experts talking about the update in the real estate markets. We're going to have the Barones on to talk about the economy and many of the things that Bob writes about in Forbes magazine. He'll kind of fill us in on those thoughts. Chris, what else do we have today? Anything?
No, I think that about covers it.
Okay. Well, everybody, we'll leave it there. We look forward to seeing you all again on the next episode of the 4-Star Today's Market Explained podcast. Be well out there, everybody. Let's leave it there. Have a great day.